Term versus universal life insurance. In this educational episode, I'm going to explain why indexed universal life, structured correctly and funded properly, is like buying term and investing the difference on steroids. Get ready. So I'm Doug Andrew. I've been a financial strategist since 1974. Also been viewed primarily as a retirement planning specialist, helping people prepare for a comfortable retirement where they will not outlive their money. Well, my favorite financial instrument, bar none, is a max-funded indexed universal life insurance contract that allows a person to accumulate their money totally income tax-free. And then when you need to access money, even before the age of 59 and a half, you can do so without triggering tax or penalties. But if you use it as an alternative to IRAs and 401ks, it ends up knocking the socks off of most of those because you can access the money tax-free. And at the end of the day, when you ultimately die, anything left behind in the policy, in the cash value, blossoms and transfers income tax-free. Now, nothing else does that in the Internal Revenue Code that I'm aware of, and I've asked many CPAs and tax attorneys that I teach in advanced continuing education to show me anything else in the Internal Revenue Code that allows you to accumulate money tax-free, access it tax-free, and when you die, it blossoms and transfers tax-free. They've yet to come up with anything to show me to do that. Now, that is provided under 3 sections of the code, 72E, 7702, and 101A. In this episode, I want to sort of explain why a properly structured, max-funded indexed universal life is really nothing more than buying term and investing the difference under a tax-free umbrella. It's like on steroids, okay? Now, when you purchase term insurance, what you're doing is you're paying for a death benefit. And the philosophy behind this, as explained by advisors out there like Dave Ramsey and Susie Orman, they say, well, if you buy insurance to protect you in the event of an untimely death, which you should protect yourself and say, in case, accidental death or something happens, is to make sure that those that you would leave behind, your spouse, your children, would not suffer an economic loss. So if you're 30 years old and you are making, let's say, $100,000 a year, you can usually qualify for maybe 30 times your income. So that'd be $3 million of life insurance. And you can't just go apply for millions and billions of dollars of insurance. You have to have a reason and justification for the amount of insurance you're applying for. And so it's usually based upon a factor of your income. So let's say you need $3 million of life insurance at age 30. Well, usually if you're shopping around for the cheapest, you would buy a term insurance policy, maybe annual renewable term or 5-year, 10-year, whatever. And you're trying to pay the least premium for that $3 million of life insurance so that you can eventually get rid of the $3 million of life insurance, 30 or 40 years down the road when you end up accumulating 3 or 4 million of cash, okay? So you buy term and invest the difference so you become self-insured. Well, what a lot of agents or advisors don't understand is universal life, especially indexed universal life, is actually designed to do exactly that, to self-insure. And they don't understand how to do this. And so what you're doing is you're taking the least amount of insurance the IRS will let you get away with and put in the most money the IRS allows. So many people that would come to me, they wanted to reposition money that was underperforming or non-performing. Maybe it was money they had in IRAs or 401ks invested in the market, and they didn't like the volatile market where they were making money and then losing money and so forth. And so they wanted to get out of that volatile market. Maybe it was non-performing or underperforming because they had money in a bank or credit union earning a measly 1%. Many times people would have maybe a piece of real estate a rental property, and it was like an albatross around their neck. They couldn't stand fixing the toilets and evicting the tenants and taking out the trash, and so they just wanted to get rid of it. So they wanted to sell this duplex or this rental home, and they didn't know what to do with the $200,000. And so people would come to me and they'd say, Doug, I want to sell this piece of property, and I need a place to put this $200,000. I have $100,000 sitting in a bank or credit union, and it's ridiculous. I'm rolling upstream at the rate of 1 mile an hour, 1% interest, and the current of inflation is coming down at 3, 5, 10. I'm going backwards. I go, I understand. And I'm sick and tired of my money in these IRAs or 401ks in the market where I make money and then I lose 40%. And people saw that twice in the decade from 2000 to 2010. They lost 40% twice in that decade. We call it the lost decade. And so they want to reposition using a strategic rollout. This is where you're rolling money out of those IRAs or 401ks, not over, rolling them out, paying the tax and putting the net into an IUL policy because it's tax-free. So based upon that example, that would be $200,000 from a strategic rollout, $200,000 from the sale of a rental property, another $100,000 coming out of a bank or credit union. So that's a total of $500,000. What I'm doing is I'm putting in $500,000 and I'm taking the least amount of insurance I can get away with. Now, if I'm down in my 20s or early 30s, the IRS requires the amount of insurance might be about $3 million, okay, to accommodate that $500,000. Now, if I'm 60, I only need $1 million of life insurance to accommodate $500,000. So the objective is not to get as much insurance. You want the least amount of insurance you can get away with and put in the most money because you want that money to accumulate tax-free for living benefits. Well, if you're young and you're 25 or 30, maybe the minimum amount under these TEFRA and DEFRA tax citations that dictate the amount of insurance you required might be $3 million. So many of my clients would go, well, Doug, I want to put in this $500,000. What's the least amount of insurance? And I'd say, well, it's $3 million. So they get the $3 million of insurance, but what the real objective is to have their money grow, to become self-insured. Well, if they put in $500,000, that $500,000, if it's structured correctly and funded properly, that $500,000, if it's earning like I've earned on my IUL, I've averaged 11.17 since 1997. I've averaged 9.62% since 1980. Your money will double every 7.5 years at 9.6. So if you put in $500,000, it's going to double to $1 million in 7.5 years. Well, then it's going to go to $2 million and then to $4 million, then to $8 million at the end of 30 years. At the end of 30 years, you have $8 million. Whoa, you accomplished your goal. Well, you did it actually faster. I ended up with $3 million of cash. Usually, okay, $500,000 would double to $1 million in 7.5 years. $1 million doubles to $2 million in another 7.5. That's 15 years. Okay, by the time I got to 22.5 years, I was up to $4 million. My cash exceeded the original $3 million death benefit. I am self-insured. So see, now the insurance company's not charging me anymore for the insurance because I have $4 million of cash. The cash value grew to exceed the original death benefit. And so that's the magic behind being self-insured. It's like buying term and investing, the difference on steroids. Because if you were a 60-year-old and you put in $500,000, that $500,000 can double to $1 million in 7.5 or 10 years, and now your cash value equals the original death benefit. In 10 years, you are self-insured. See, a lot of agents say, well, no, you use increasing death benefit. That means the insurance company is going to keep charging you for the original $1 million of insurance. No, I want to use this for living benefits. I want to become self-insured as soon as possible. So most of the time, when I do this for people, the cash value equals or exceeds the death benefit within 12 years, within 22 years. And so now they are self-insured, whereas most advisors, the Dave Ramseys and the Susie Ormans, Your money inside of that portfolio is taking 30 or 40 years to equal that. And then that's not what you're going to net. You pull it out and you're going to have to pay tax on a third of it. So why would you do that? Money inside of an insurance policy is tax-free. I can be self-insured and have the cash value equal and exceed the death benefit in about half the time as buy term invest the difference proponents. And it's totally tax-free. So why wouldn't you do that? This is why it's like buy term invest the difference on steroids. Now, my critics out there, they go, oh, I've never seen an insurance policy that does this. What you're saying that this gets cheaper as you get older? And I go, yep. Well, I've never seen an insurance policy that gets cheaper as you get older. Then you haven't seen one structured like I'm talking about. Because when you actually have the cash value qualify as part of the death benefit, and you take the least amount of insurance based upon your age and your gender and your health, the cash value will grow to equal or exceed the death benefit, usually within 12 to 20 years. And now the insurance is free. I mean, if you die, it transfers tax-free, but you're not paying for the insurance anymore. The insurance is actually now growing with your cash value. And there's a lot of agents that do not understand that concept. The insurance gets cheaper as you get older. If I put in $500,000 and the minimum insurance is $1 million, the net amount at risk is only the remaining $500,000 now. When that $500,000 doubles to $1 million, there is no net amount at risk. The insurance company is not going to charge me anymore for $1 million of insurance because my cash is now equal to the insurance. Does that make sense? But now the $1 million can double to $2 million faster. Totally tax-free, and then to $4 million. If this is intriguing you, you need to learn how to do this correctly. So if you want to buy term invest the difference tax-free and do it on steroids, I would recommend you learn about how to structure one of these correctly. If it is what I call a laser fund. Laser is an acronym that I've used for years that stands for Liquid Assets Safely Earning Returns, okay? A laser fund is a property-structured max-funded IUL. So you could study this book. It's 300 pages and purchase it on Amazon for $20. And if you do, thank you. But you don't have to do that. I'll gift you one free. Now, it's actually 2 books in one. This side is about 200 pages, 14 chapters with all the charts and graphs and explanations if you're a left-brain learner. If you're more of a right-brain learner, you learn by stories. You flip it over and read this one, 100 pages, 12 chapters, 62 actual client stories of how max-funded IUL can be used for retirement, college funding, working capital for your business, emergency funds, on and on and on. It's the dream solution for many financial goals. If you want to use your whole brain, left brain and right brain, read the whole book. But simply go to laserfund.com and you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll pay for the book. I'll fire out a hard copy to you. While you're in there, check out if you like to listen and learn or watch and learn. There's audio and video versions. There's even an 18-hour masterclass on this. You'll really be educated. But if you want to check out some of our educational webinars we do on a regular basis, there's no charge. Check those out when you're in there, claiming your free copy. Also, you could even schedule an appointment with an IUL specialist that I oversee and mentor so that they could create an illustration of a properly structured IUL for you at no charge or obligation. So this is not about me. This is about you and your brighter future.